Good afternoon, everybody. This is Greg Sweeney. Welcome to the conference call. Our third quarter 2024 economic outlook will follow the same pattern as the previous outlooks. We'll take a couple of topics, look at them on a high level, and give you some idea of what we see in store for the economy and the investment markets for the third quarter 2024. It's been a great start to the year. The S&P 500 is up about 15%. The NASDAQ 100, which is more concentrated with technology stocks, is up about 17.5%. The Dow Jones, though, is just a shadow of those two numbers, up 4.8%, and the S&P 600 is actually down about 0.75% on the year. So if I was to interpret that for you, I would say the market's returns are concentrated in a handful of large technology names, while returns outside of those names are much more muted. We see that in the Dow and the S&P 600. We've seen this type of market environment before, so this is not the first time. If you are readers of our monthly economic outlook, you will get more information on the last time we saw this if you read July's outlook, which should be posted on our website here in the next couple of days. Interest rates from the bond market, interest rates have been fairly stable within a range of about 4 to 5% this year. And we expect that you're seeing these interest rates and saying, wow, they're a lot higher than they have been most of the last 15 years. And that is the case. They seem high in relation to those more recent numbers that we're used to. But if we look prior to the great financial crisis in 2008, this is a much more normal interest rate. And this type of environment existed for many, many years prior to the interest rate experiment and the low Fed funds rate that we saw really from 2008 to about 2020, 21, somewhere in that range. I suspect that this environment that we see today is probably with us for the foreseeable future, and we are not going back to that ultra low interest rate environments that you may have more familiarity with over the last 15 years or so. One other area, major investment area that is causing some concern in portfolios to the extent they have allocations to real estate is the commercial real estate market. The commercial real estate market is still under pressure, but this is normally not a big allocation in investors' portfolio, so they don't probably see this pressure as much as they would if there was pressure coming from the bond market or the stock market. Gross domestic product is a measure of how fast the economy is growing, and the economy continues to grow. We're seeing GDP go up about 1.5%, 2% or so annualized rate this year. So it's still moving higher, but at a slower pace than we've seen over the last couple of years. If we were to look at the components of GDP, the three largest components are the consumer, which make up about 2/3 of GDP, and then government and business spending makes up about the other 1/3. Pretty even balance actually between government and businesses. Business spending making up the other third of the market, GDP, excuse me. But what we're seeing is consumer expenses or consumer purchases grow at about 4.7% annual rate, but government and business spending is growing over 6% for each one of them. That's unusual to see government and business spending outpace consumer spending, especially when consumers are about 2/3 of GDP. What I would suggest, given that information, is that the consumer is becoming more cautious. And they're becoming more cautious for a couple of reasons. One is that their savings rates are down, so they don't have the ability to tap their savings as much as they have over the last couple of years. Interest expenses on their debt is also going up as interest rates are higher. Credit card, auto loans, things like that are often revolving or floating interest rates. So as interest rates go up, those payments go up, and those costs are higher. The unemployment rate is also starting to drift higher, which offers consumer less flexibility in terms of finding those new opportunities or even finding the first employment after they're done with school. So there's a couple of causes for the consumer to be cautious, and the other one that I have on the screen, just put on the screen, is revolving credit or consumer debt. So we mentioned that interest rates are going higher, so interest costs on that consumer debt are higher. At the same time, The debt itself is moving higher. In the last few years, it's gone from about 4.2 trillion total consumer credit. This does not include mortgages. This is just credit cards, auto loans, things like that, up to $5.05 trillion. So more debt, higher interest rates, more outlay for just servicing that debt, less money for consumers to spend on goods and services. Inflation is also a big part of this economic growth environment. We hear economists say that inflation is going lower, and indeed it is, but economists are quoting inflation using the left scale and that red line you see on this chart. Prior to inflation taking off, we were looking at an inflation rate of about 1.5%. By about the middle of 2002, inflation was at 9%. And so when we hear the financial networks talk about inflation going down, the economists are quoting that red line. Okay, the annualized inflation rate is down from 9% in the middle of 2022 to about 3.3% today. And it all sounds great, but you and I as consumers experience inflation in a completely different way. We experience inflation like you see on the blue line on this graph. At the beginning of 2021, something that cost us $100, I'm looking at the right-hand scale now, something that cost us $100 cost us about $119 today. When economists say that inflation is going up at 3.3%, what that simply means is what costs us $119 today is going to cost us about $123 in next year at this time. Okay, so when the economists say that inflation is going down, the translation to you and me as consumers is that the cost of the basket of goods that we buy today for $119 is just going to take a whole year to get up to $123. But it sure has moved significantly from the beginning of February or beginning of 2021 till today. And this is why our savings rates are down as consumers. This is why we have taken on more debt, is our incomes really haven't kept up with the rising inflationary environment. And that's how we're maintaining our standard of living. So this is why inflation causes so much anxiety and stress in a consumer, is because we can experience it dollar for dollar. We don't experience it on an annualized year-over-year, change like economists quote it. So I hope that puts in better perspective the effect of inflation on our budgets as consumers. So as we look forward, to try to translate some of this stuff that we've just talked about into an investment strategy and what it looks like for the third quarter of 2024, a couple things to note. It's election years where we take a lot of calls from people. Republicans are afraid that the Democrats are going to stay in office. Democrats are afraid that Republicans are going to take the office. And they want to do something to their portfolio to protect against the other side. Here's the reality of it, though, is very little happens, right? Half the population is mad because the other half because one or other candidates got in. If it's reversed, half the population is still mad, okay? So in election years, the stock market tends to do fine. The economy grows, but so does anxiety as we try to predict who's gonna be in office. But the reality of it is the short explanation is don't try and adjust your portfolio because you want one party or the other to get into office. As we look at the potential hurdles that we think that face the economy right now, one of them is the growth in federal debt levels. You might have heard financial stories about how GDP is about 100% of our federal debt. The reality of it is, if we add the debt that includes Social Security, our debt levels are well in excess of our GDP levels right now. It doesn't matter who gets in office, the Republican or the Democrat. They both have about the same spending plans, which are to add about $1.5 trillion in more debt every year. At the federal level. It's just that they'll be spending it on different things. Okay, so one party or the other probably doesn't slow that down. The biggest hurdle for federal debt growth will probably end up being the bond market. The bond market just won't finance continued deficit levels at the rate of $1.5 trillion a year forever. So at some point, the politicians are probably going to have to come to grips with that. I don't know when it happens, but it's probably the bond market that forces that discipline on the debt growth levels and growth rates of federal debt. Commercial real estate is still an issue. Banks that have financed, metropolitan, high-rise, multi-tenant office space, those loans have come under pressure. And so far, the regulators haven't been forcing sales of those type of assets off of bank balance sheets. But if some of those sales start to begin to be regulatorily implemented, that could put significant pressure on the market as a whole. And then finally, the soft landing concept. The soft landing is the economy slows down, unemployment goes up a little bit, but doesn't go into a recession, right? That's kind of the idea of a soft landing. And if that soft landing fails to materialize, and in fact we go into a recession, probably puts pressure on the bond market and the stock market, more on the stock market than the bond market. But soft landing failing to materialize, and if we are slowing down, it risks the chance of a recession. If that does happen, I suspect it will be mild. I don't see that happening in the third quarter of 2024 specifically, but it's a little bit longer on the horizon if that fails to materialize. I will add at this point, though, that there's not much history of a successful soft landing, okay? Usually by the time the Federal Reserve realizes that the economy is slow to the point where they can finally start reducing interest rates without risking inflation moving higher, it's too late, okay? So not much history of successfully implementing that, and I suspect this time is probably no different. In terms of portfolio positioning, we favor U.S. allocations. If we look at the overall allocations of a market as a whole, roughly 35-40% is in developed foreign. We only have about 20%, so we're favoring U.S. So far, that has worked real well. We continue to hold that position. U.S. GDP growth rates are significantly higher than developed foreign growth rates as a whole, so we like that positioning. I mentioned earlier that S&P 600, which is a small cap index, is actually down 0.75% on the year compared to 15% for the S&P 500. We are maintaining what we call SMID positions, so small and mid-size equity allocations. They're not large. The two of them combined are probably 12, maybe 15% total. Those aren't doing as well as you might have surmised. But the overweight in U.S. is making up for those allocations. We're reluctant to give up SMID allocations because they do represent significantly more value in this elevated market environment we're seeing in large caps right now, particularly the tech names, the large tech names that where returns are so concentrated so far year to date. We see fixed income as more of a contributor to results. What I mean by that is interest rates are noticeably higher than most of the last 15 years, and they do provide meaningful income to a portfolio now. It wasn't too long ago, 3 years ago, 4 years ago, where a 10-year treasury only had a yield of about 0.75%. That didn't do much if you're an investor. You saw a chart earlier, the 2-year treasury right now is almost 4.75%. That's a meaningful contribution to a portfolio, particularly portfolios where retirees are taking money out to live on through their retirement years. Finally, personal investment profiles. Okay, I know you probably hear me say this a lot, but I'm going to say it again. Portfolio allocation should be based on long-term secular outlooks, really focused on your goals as an individual that you're trying to reach over long periods of time. I know it's really easy to get caught up in cyclical environments, like the tech stock AI craze that's going on right now. I mean, if you don't have NVIDIA, you don't have anywhere near the returns that I was mentioning at the beginning of the presentation, right? S&P's up 15%, but the Dow's up less than 5%. It's really easy to get caught up in that. And once you get caught up on that, you start to over allocate to it. But it's really hard to tell when that environment changes. It's really hard to time both getting in and getting out, which is why it's so important to focus on your long-term personal investment profile and your ultimate goals, and to take the slow path rather than try and take the fast route and then miss timing the market, because odds of consistently timing the market year in, year out are very, very low. Matter of fact, I even go as far as to say impossible. So with that, I'm going to wrap things up. Thank you very much for joining us today. We appreciate your business and confidence in Bell.